Silver didn't just go up. It slipped out of the system. For more than 40 years, silver stayed inside a box. Prices stretched, snapped back, and behaved. Then that box cracked. In January 2024, silver traded near $23. By January 2026, it was over 117. That's not momentum. That's a repricing event. And here's the contradiction that should bother you. The quoted price says silver is available, but the real-world cost says it's not. Premiums to acquire physical silver jumped from roughly $3 over spot to as high as $15. The market price no longer reflects the true cost of access. If you're watching this, it matters because price only works when delivery works. The paper market trades volumes dozens of times larger than the metal that actually exists to be delivered, yet there was no blow-off top, no panic candle, just a steady grind higher. But here's the part nobody is saying out loud. Markets don't reprice like this unless something underneath has already broken. So the question isn't how high silver goes. It's what stopped holding it down. What looks like a silver story is actually a market structure story. On the surface, the event is simple. Silver rose sharply over 2 years, but that framing hides the real shift. The move didn't begin with excitement. It began with quiet dysfunction. Futures prices continued to trade smoothly while the physical market started behaving as if supply was fragile. That disconnect is the signal. The paper-silver market trades volumes roughly 50 times larger than physical deliveries. Price discovery depends more on leverage than on metal. For decades, that leverage worked. Mean reversion strategies assumed abundance. Contracts rolled. Delivery was rare. But starting in 2024, physical acquisition costs stopped tracking the spot price. Premiums widened even as volatility stayed low. That's not how speculative manias behave. This wasn't an isolated incident. It fits a larger pattern across markets where synthetic supply suppresses price until it suddenly can't. When inventories fall and demand becomes insensitive to price, leverage stops anchoring value and starts amplifying risk. Here's the reframing question most people miss. If the quoted price is accurate, why does every real transaction say otherwise? And once that question spreads beyond traders to institutions, the story moves into its next phase. Here's the claim that sharpens everything. This isn't a demand surge, it's a supply failure being masked by paper. COMEX eligible silver inventories fell from about 290 million ounces in January 2024 to roughly 147 million by December 2025. Registered silver, the metal actually available for delivery, stood near 124 million ounces. Now place that next to open interest. The futures market represents claims on silver that exceed deliverable supply by roughly 4 to 1. In normal conditions, that imbalance doesn't matter. Most contracts never touch metal. They settle in cash. The system assumes trust. But notice what's missing. There was no announcement that inventories were stabilizing, no confirmation that supply chains normalized. Instead, physical premiums kept widening while futures trading stayed calm. That combination is rare. Stress is being absorbed quietly, not released. This is how structural breaks form, not through panic, but through denial. Leverage keeps prices orderly until delivery becomes relevant. The moment enough participants prefer metal over settlement, the math flips. And once delivery becomes the focus, every contract stops being a trade and starts being a question. Can the system actually deliver? Now watch how that stress moves outward, because when supply tightens at the core, behavior changes at the edges first. By January 2026, major bullion dealers did something they rarely do. They restricted access. Pre-sales disappeared, purchase limits appeared, shipping windows stretched to 6 or even 8 weeks. Major North American dealers implemented these restrictions as inventories tightened. They could no longer replace metal at prices that made selling safe. This is where the pattern mirrors something familiar. Bank runs don't start with crowds. They start with quiet rules, limits, delays, temporary measures. The goal isn't transparency, it's survival. In silver, the same psychology applied. Dealers raised premiums not to boost margins, but to slow demand. Selling metal they didn't physically possess became a liability. And here's the normalization that matters. When dealers prefer holding silver over holding currency, they are telling you which asset they trust more. That behavior feeds itself. Restrictions signal scarcity. Scarcity accelerates demand. Demand drains inventories further. The loop tightens. This is no longer a trading environment. It's a preservation environment. And once markets enter that mode, reversals don't come easily. This is where the narrative stops being financial and starts being physical. Because unlike past silver rallies, this one isn't driven by investors chasing returns. It's driven by industries that don't get to opt out. In 2025 alone, solar panel production consumed roughly 173 million ounces of silver. That demand wasn't speculative. It was contracted, planned, and locked into government and corporate roadmaps. Solar and electronics manufacturing represent a fixed, ongoing draw on silver supply. 5G infrastructure alone consumes around 40 million ounces annually. Now, here's the detail that changes how you see the entire move. There is no viable substitute for silver in high-efficiency applications at scale. Manufacturers already reduced silver usage per unit over the past decade. They hit the physical limit. Go further and performance fails. Rising prices do not reduce demand. They increase urgency. Industrial buyers don't wait for dips. They secure supply. And when availability becomes uncertain, they don't hedge prices. They stockpile metal. That shifts demand from just-in-time procurement to strategic hoarding, removing silver permanently from circulation. Add AI data centers and electric vehicles, and the imbalance deepens. Industrial consumption alone is approaching, and in some projections exceeding, global mine supply. At that point, price stops being the gatekeeper. Availability is. And that's when markets lose their ability to self-correct. And now the pressure stops building slowly. It starts stacking. Because inventories don't just decline smoothly. They lurch. In one recent 3-month window, more than 31 million ounces of silver left COMEX vaults. Not over years, over weeks. At the same time, registered inventory, the metal actually available to satisfy delivery, covered barely a fraction of outstanding claims. Registered silver represents only a small share of total exchange inventory. The margin for error is gone. At the same moment, LBMA vault holdings in London fell sharply from roughly 1.2 billion ounces to around 900 million. That metal didn't rotate back into the market. It was absorbed by institutions and sovereign entities. Once that metal is locked away, it stops acting like liquidity. Now stack the developments. Dealers restrict sales. Industrial buyers hoard. Exchange inventories drain. Futures markets continue to trade calmly. Each layer increases pressure without releasing it. This is how mini-crises form, not through explosions, but through compression. The system keeps functioning until one demand spike, one delivery surge, or one supply interruption forces a binary decision: deliver metal or change the rules. This is the point where the story leaves charts and starts touching daily life. Because when silver tightens, it doesn't stay confined to exchanges or vault reports. It shows up downstream. Delayed deliveries mean factories miss deadlines. Higher premiums quietly raise costs across energy, electronics, and infrastructure. Projects don't stop. Budgets stretch. Consumers absorb it without ever seeing silver on a receipt. And for individuals, the change is immediate. Buying physical metal stops feeling like a transaction and starts feeling like a negotiation. Products disappear, minimum order sizes rise, buyback rules harden, dealers want larger lots before they'll even quote. That's not volatility, that's friction entering access. Here's why that matters to you. Every system people trust behaves the same way under strain. When access becomes uncertain, behavior changes faster than prices. People stop asking whether something is cheap or expensive. They ask whether it will still be there. This isn't ideology, it's pattern recognition. We've seen it with fuel, food, housing, and money itself. Scarcity doesn't announce itself loudly. It shows up as inconvenience first. If this feels familiar, say so in the comments, because once enough people recognize the pattern, the market doesn't wait for consensus. Now zoom out, because outrage won't help you understand this. Structure will. This isn't happening because one group made a bad decision. It's happening because incentives aligned in a way that drains resilience from the system. The paper silver market runs on trust and leverage. As long as participants believe contracts can be settled smoothly, leverage creates the illusion of abundance. But the moment that belief weakens, leverage flips from control to fragility. The paper market depends on most participants accepting cash settlement instead of delivery. The system only works if delivery is rarely tested. Here's the unsettling part. Every major actor is behaving rationally. Dealers restrict inventory to survive. Industrial buyers hoard to protect operations. Institutions hedge against currency debasement. None of these actions are extreme on their own. Together, they strip liquidity from the market that depends on circulation, and spectacle hides it. Calm price action is mistaken for stability. Low volatility is read as safety. But in reality, pressure is being absorbed quietly, not released. This is why mainstream coverage misses the shift. There's no villain, no crash, just a system optimized for efficiency discovering it has no redundancy. When promises meet a world that suddenly wants proof, rules don't fail dramatically. They just stop working. Now look forward, because this phase is about trajectory, not prediction. From here, two paths stay open. In the first, the system stretches, exchanges lean harder on cash settlement, margin requirements rise, rules adjust quietly, the paper market survives in form, but physical premiums remain elevated. Silver becomes expensive, yet still obtainable under controlled conditions. The second path is sharper. A trigger hits, a delivery surge, a supply disruption, a macro shock that makes institutions question counterparty risk. In that scenario, futures stop functioning as price discovery and start behaving like liabilities. Physical metal detaches. Prices gap not because of excitement, but because sellers step back. Inventories are not rebuilding. Industrial demand is not retreating. Time favors stress, not normalization. What matters most is uncertainty. No one knows which trigger lands first, but the next move won't come from retail enthusiasm or headlines. It will come from a quiet institutional decision where someone decides metal is safer than a promise. And once that decision spreads, the market doesn't transition smoothly. It snaps. Here's the insight that reframes everything you just heard. This was never a story about silver going up. It was a story about confidence going down. For decades, value was set by promises that rarely had to be tested. Futures, leverage, settlement systems, all of it worked because delivery didn't matter. Now it does. Physical availability, not quoted price, is driving behavior across dealers, industries, and institutions. The hierarchy of value is quietly reversing. Silver is simply where the break became visible first. Not because it's special, but because it sits at the intersection of industry, finance, and trust. When that intersection fails, price stops being the answer and possession becomes the question. The deeper loop is still open. If this resolves cleanly, it changes how markets are managed. If it doesn't, it changes how value is measured. Either way, a 40-year era built on financial engineering is ending. The next chapter won't be announced with headlines. It will show up as silence where liquidity used to be. If you want to track what breaks next and why, stay here.